And so we are live. Welcome to Built to Sell. We actually will have 5 of us on here at various times during the event. We're watching for Simon to come in with this technology. I hope I see him arrive, and if so, I'll let him in the door, because when you arrive, I can't actually hear you speak. Letting people kind of get settled, and I just got an alert that my YouTube channel has this going live. So we're live on LinkedIn and Facebook and YouTube. We'll have this stay live after the event for about 24 hours, and then we'll have it as gated content that is also still available. So if it disappears on you and you wanted to show it to a friend, reach out to us at Podium Prosperity Group, and we will get you connected to that content again. So I'm going to be introducing us variously throughout the presentation. So I'm going to bring our PowerPoint onto the stage to help people stay with us, and I will remove Jake and Oren and bring you guys back in a little while. So here we are in Built to Sell, which is about maximizing valuation and saleability of your business. Because what that equals, whether you want to sell that business or not, is a business with profit and time freedom, which is very exciting. It's really the goal that people have when they're building a business, is to have it pay off, not just later when they someday sell, but today as well. Little note, this is our disclaimer. If you're here in person, you'll even get a copy of this tomorrow. This material is the theory. We're not working on your specific business. So that means that any financial forecasts are subject to uncertainty and contingencies that we don't control. And if you would like to work with us on your specific situation, being able to drill into your numbers, then that allows us to give you better advice that will pertain more to your particular business. And of course, you're responsible for taking action, making the judgments around your business, and knowing what will work for you. On the screen right now with this slideshow, you will see your coach consultant team, who you may remember from our web TV, our breakfast with your coach consultant. Jim Pelot is the business consultant. I'm Cher Cunningham, your business coach. And I'm actually going to get you, Jim, to say hello and introduce yourself and give a 1 or 2 minutes around some of the background you bring to our coach consultant advisory team.
Welcome everyone to this VIP event, Podium Prosperity Group. We've been on air every morning, Cher, talking about various pieces of this. So it's really nice to be here this evening, and again tomorrow live in person, talking about Built to Sell. So my background is I'm a chartered accountant by training, and I have been doing startups since the late 1990s. This is my 5th startup, a couple in biotech, a high tech, and a couple of financial services companies, and now an advisory firm. So I have been the CFO of a public company. I have bought companies. I have sold companies. I have advised people on buying and selling companies. So I'm just delighted to be able to share my experience, and hopefully you'll find it really, really valuable as you build your business and work towards creating an asset that'll have a tremendous value and impact to your life and your legacy.
Wonderful. Thanks, Jim. And I am Cher Cunningham. I'm your business coach. I have a background in marketing and online marketing, in training, and in franchise development with a team that I worked with. I started out on my own as a business coach, realizing that people needed some additional work to become more strategic, to tap into their vision and bring it to life. And they also needed the mindset and the accountability and support to encourage them on their path. I met Podium Prosperity Group and realized that what I was missing was that financial acumen, the ability to project that dream into the future in a concrete way, and merged my company with Podium 2 years ago, almost now, so that we are able to serve clients together in a fashion that is very fulsome, that allows them to take concrete actions that bring those dreams, that vision, those goals into reality, and in a measurable, trackable way, which is incredibly powerful. what I've discovered is that often people didn't necessarily respect their business to the level that it grew to. And discovering the business that they have from those financial projections can be a very surprising thing as they realize what they've created that is bigger than them. So together, we've created this business that helps those entrepreneurs who've built a business bigger than them. When they reach that point where the business feels like it's consuming them instead of fueling their life, that's often where we meet them. And then we bring them along the roadmap of business growth through to the point where they have that saleability, that exit opportunity. Beginning with the end in mind is very important. Right? See the business you're building, not just looking at what's happening today. It's part of where your motivation comes from. When you begin with the end in mind and you create that bigger dream, you'll find that it's not about money. It's about what money provides. You'll find it's not about today's concerns. It's about the impact that you want to have. And you start making those decisions today that put you on that trajectory. You get out of the this week, this month decisions, and you're making those larger decisions that will bring you towards that vision more surely. Stop over-identifying with your business. You'll see a lot of marketing that talks about you are your business. And in order to build an asset in your business, something that is bigger than you, then you need to be able to step out of it. So it's not Cher Cunningham coaching. It is a larger company. And that means stepping into the identity that you're a business owner, and that helps you not be owned by the business. It's a lot of mindset work that needs to happen in order for you to prepare to consider a business that is built to sell. And we'll have that kind of interspersed as we go along this evening, so that you can pick up on some of the things that might be holding you back or getting in your way.
One of the things that we used to say to our investors when we were a small biotech company is literally that we were actually a large company in a small company's body. So always thinking about how big you might get and how you might exit.
It really is about that identity, the identity of the company as well, right? That ability to see what you're building, and everything starts at the same point, goes through the exact same journey when it comes to business decisions and business growth. So although you have a very unique company, the business journey we're all on is shared. So this training, this VIP event is about how to make your business both saleable and valuable. And those are actually different things, aren't they, Jim?
They absolutely are. And they're intertwined, of course. You saleable businesses have to have some value. But really, this is about grooming the business and ensuring the business is a thing that is saleable. And the large piece there that you've already identified, Cher, that we're going to talk about in a lot more detail, is having something separate from yourself. The valuable piece is understanding who might buy it, how you might exit. And there are so many ways to exit. We're going to talk about some of them tonight, and how to maximize the value in anticipation of a sale. And I guess our main message here for the next couple of days is always be anticipating a sale. You never know where you're going to get a great offer.
That's great. One of the challenges is people don't imagine themselves being able to sell their business. Even people who purchase their business don't imagine that they can sell their business, because they don't have the skill set, they don't have the experience, and they're not sure how to think through it. So taking this step to expose yourself to some of this education, some of the experience, and the people that we're bringing on board this evening to share their wisdom, because they have been there. Until you've been there, it is impossible to picture. So tapping into the thought processes and some of the pieces, while it's complex, it's as complex as it needs to be so that you end up building the business and creating the result that actually matches your goals. And I love the fact that everything you do that creates a saleable business actually makes your business pay back for you too. It fuels your life. The things that make somebody else attracted to your business, you're going to love about your business as well. So the sooner you do these things, the more your business becomes something that doesn't own you, that you start getting some time freedom, you start building that financial freedom. It is about a couple of pieces. One of the places I sit in as your coach is the independence, the business not being you. And I'm going to talk a little bit more about that on the next slide. And then Jim really talks about that financial piece, because understanding why your business isn't profitable, why it isn't paying off, comes right down into dollars and cents. Recognizing the business is not you is vital. There are things that you brought to the business, the way that you do something, the need you saw in the marketplace, the process you designed, the intellectual property that you bring to it, that at first can feel like it has to be you. That you are the one that makes everything sing, that you have to talk to the clients, you have to serve them. And as your business grows and you get 3 or 4 or 5 or 6 or more people working in the business with you, you start to recognize that that means you're making all the decisions, you're putting out all the fires, and you're never offline. The ability to recognize that you learned this, and that means it's teachable, allows you to take some steps forward to make that business separate from you. And it needs to be independent from the whale customer that you might be attracted to as well. No more than 15% of your revenue should come from a single customer. Often when we first meet businesses and they're at that stage where the business has grown to that size that it is bigger than them, they think that if they just get a big customer, they'll get that first revenue coming in that will give them some freedom, some breathing space. But of course, the opposite happens because you become owned by that client. You become essentially an employee because they are so important to your company that you have to cater to them. It needs to be independent from you so that you don't have to be making all the decisions, doing all the quotes, managing all the problems. And it needs to have independence from key employees as well, which means there's someone who might be your right-hand person who you count on, that you're burning out and you're burning them out at the same time because they have skills and knowledge that's all in their head as well. That independence piece is a process. It's a system of systemizing and making wise decisions that will slowly and sometimes almost instantly in other situations move you out of the business being so dependent on you, which can lead to things like, a 4-week vacation, a good night's sleep, time feeling present with your family, things that you've kind of given up on sometimes when the business has grown to that size. Another place that you need to look at is intentional marketing, the business happening to you and from only the people you know and only the people that you've met and only the customers. We'll often hear people bragging about word of mouth marketing being the source of their business, that clients are the source of the next referral. What that means is that the marketing isn't under your control. So as we work with you to become intentional about that, as you're looking at making your business saleable, it has to have that on-demand marketing that you can turn on and off, because a scattershot and wishful thinking marketing is not an attractive business to you or a buyer. Getting things out of your head, getting your marketing down, learning how to trust your team and be able to delegate not just little jobs, but the entire thinking and decision-making process around the different roles in your company is a huge step in getting this business to be a separate asset from you.
All right, so we're going to go through a few fundamental financial concepts here that are important to understand in order to sort of build up to where value comes from when you're selling a business. And one of the things that often happens as clients arrive with us, they're struggling financially for a number of reasons. And it's not unusual for us to start working with clients who are in the million to $1.5 million revenue range with earnings before tax of somewhere in the 3% range, which is obviously not enough return on their time and investment, right? You're taking a lot of risk running a business, and you certainly want to be rewarded for that beyond your salary. So a starting place, and this is a classic service business example, and every industry is a little bit different. If you're construction, it looks different because you have big cost of goods sold. If you're a distributor, it's different. But in a services company, you can think engineering firms, architectural firms, bookkeeping firms, accounting firms, anybody who sells their time for a living or the time of their employees. This is approximately what you would expect to see classically in a profit and loss statement. Your cost of goods sold are 50%, which means that your gross margin, which is a measure of how efficiently you deliver your services, is about 50%. You can think of allocating 20% to sales and marketing, 20% to general and administration, and that leaves sort of 10% profit. And in this case, and we're going to use this consistently throughout this discussion, we're not taking into account interest and taxes. So that EBIT on the bottom is earnings before interest and taxes. And the reason, well, I'll explain why later, but those things are not really relevant to the discussion that we're going to have. So keep in mind that 10% as a target that we're aiming for in this model.
Yeah, I like that while this may not be standard for your industry, it's a good starting place. And what we would always want to do is look at what is that standard for your industry, because fixing this, if it's broken, is very important. Success is math. And if you are wondering why these numbers don't make sense to you, why you don't have return on sales at the end of the year, why it seems like you're consuming capital and having to finance your business, it comes down to the math, making your business both profitable, and then that right size piece that is so important, that a profitable business that's the wrong size isn't really a place you want to be either.
One of our mantras for companies that are in this phase of business growth, and we'll talk about that a little bit later, is that, as Cher mentioned, the tendency is to want to grab a large customer, or frankly, sometimes any customers, thinking that if you add revenue, that you can grow your way out of a financial challenge, and that's usually not the case. So growth consumes capital. So our motto and model is for companies in this particular range of business is scale your profit first. So take the revenue that you've already got and make yourself more profitable, which is the consulting advice that we provide in detail with clients that we work with, again, of this size. But it does happen that we have clients who start working for us that aren't actually at the right size yet to produce the amount of net profit necessary in order to implement some of the strategies that are needed to get through that phase of business. And what this chart shows, and I've circled in green kind of in that model where you got a 10% return on sales, your revenue needs to be about in the $1 million range in order to produce enough net profit to be able to, for example, hire somebody to get yourself out of the business. And we talked about how important that is from a saleability perspective, that you have to be, the business can't be you. The business has to be outside you. So this is just an illustration to say, at $1 million of revenue, we do work with people that are smaller than that, but the focus then is, let's figure out how to get you fairly quickly to the $1 million revenue level so that you have enough profit to start transitioning your business away from being you.
Yeah, there's a couple of traps that we help people avoid here, because when they're looking at the idea of, oh, I've got 500,000 in revenue, I should be able to draw more from this company. Maybe I need to charge more, or maybe I should just draw more. They can end up sabotaging their company's growth by not understanding that if your ratios are right, if your business model is right, and you don't have the result, the return that you need for your lifestyle, it's actually that your business needs to be larger. So getting that ability to analyze that and understand how it can be larger, right? That's where that temptation to get the bigger client comes from. We have another video on Entrepreneurial Poverty and Zombie Businesses that goes into depth on this. If you're curious how that happens, we are happy to share how this goes wrong and how to make it go right.
And again, this is the 10% return on sales. But as I mentioned, it's not unusual for us to start working with a client who's already at the $1.5 million to 2 or even more than $2 million in revenue in this program that we have. We have other programs where they've got 3% return on sales. So if you're $2 million and you have 3% return on sales, you're only making $60,000 a year. So it's scaling the business first and fixing the profit.
Yeah, scaling profit and getting to what industry standard is a very interesting confrontation of your pricing and your client that makes a difference and puts you in a place of confidence, because often people think they're overpriced when in fact when we bring that information in and show them the basic math of what makes a sustainable business and one that will support your lifestyle, it really is that neutral, that logical. So saleable and valuable comes from this model, this three-legged stool of what needs to be pulled together.
This is a diagram that I really enjoy talking to people about. And each one of the blocks, each one of the legs is a very extensive discussion. We're going to cover some of the detail tonight, but the value of a company is really predicated on these three things, which is to say the cash flow of the business is an important thing to a buyer, and to a seller, of course. The know-how, which is to say, how does your business run in a way that's different from your competitors? What makes you an attractive opportunity for a buyer relative to your competitors? How are you different? What do you know? How do you run your business? So it's know-how. It could be intellectual property, but it really is just how you run your business. And the third piece, we're very excited to have our guests with us today because they'll be talking about this much more extensively, is what data do you have? What information do you have on your customers? What financial history do you have that you can share with a potential buyer? So data is an important underpinning to the whole value of your company.
And just diving into that a little bit clearer, just to be able to see some specifics on what does that really mean?
So cash flow, and we're going to talk about some attributes here. How much recurring revenue do you have? So what history do you have of producing revenue? If you're a builder and you don't have a brand, then every sale of every new house is new. Whereas if you're a software company or a bookkeeping service or an accounting firm where 90% of your revenue is assured every year because you do the tax returns or the bookkeeping for the same businesses every year, those are very different valuation models. How much have you grown? What is your profit margin? Are you at 10%? Are you at 3%? Are you at 20%? How do you compare to other companies in your industry? How fast are you growing and what are your growth opportunities? What are your competitive advantages? And what do you understand about your own business and your customers' behaviors?
Excellent. Here's a favorite question. What is goodwill? And do I need to care? There's a lot of misunderstanding about what goodwill actually is in the market.
This is I'm going to say a little bit of the crux of the cash flow piece of the value of your business. It also involves the other attributes. It involves the know-how and it involves the data. But this is really a mathematical thing. And people go, what is goodwill? And some people will say, oh, it's your client list, or goodwill is your relationships with your vendors, or goodwill is you've got the right corner of Main Street and High Street, and so they call that goodwill. What goodwill actually is technically is the excess of what a buyer will pay for the fair market value of your actual assets in your business. So if you're a trade and you have trucks and you have inventory and you have equipment, and the example we've given here is somebody has just offered you $2.7 million, $2.75 million for your company. You've got $516,000 worth of fair value, which is often different than book value, as you know, because it depends on how it depreciates and what it's worth. And sometimes you have uncollectible receivables. So the fair value of your assets less the fair value of your liabilities, which are always worth what they're worth, right? Because you don't get to write off vendors, you only have write off receivables. What's left after you do those calculations is goodwill. So the buyer knows that they're buying $516,000 worth of your trucks and inventory and houses under construction if you're a builder, and they know they're going to have to meet the liabilities that are coming with your business, and in this case, $148,000. The fact that they want to pay you $2.382 million more for your business than the stuff that they can touch and feel with their hands is actually goodwill. And goodwill is their belief about the value of the future cash flow of your business. That's actually what goodwill is from a technical perspective.
And as we drill down into that belief, I think that's an interesting concept to start from, to say, how do you create that belief? Because it doesn't just magic out of thin air. There are some details on how that buyer forms an opinion of what that goodwill's worth.
And we're going to talk about that a little bit now.
Mm-hmm.
So quickly back to terminology. So this will run throughout. We're always going to talk about earnings before interest and taxes, and it's used as an estimate of cash flow. There are other things that move in cash flow, but generally it's used as an estimate of cash flow because it excludes how the company is funded. So you might have one company that's been self-funded, another company in the same industry that borrowed in order to grow. And this takes the way the company grew from a financial perspective out of the equation to look at really pure profitability. And lots of different companies can have lots of different tax situations because they've got loss carry forwards and that kind of thing. So you take out interest and taxes and it makes it much easier to compare companies. Okay, call this the rating game. This is kind of fun. So imagine a person that you know casually. Maybe it's a neighbor, maybe it's somebody you met in a charity or at a bar that you got to know. Anyway, they offer to pay you $1,000 now for your help with something, but they tell you, listen, cash is really tight right now. So could I pay you a year from now? Would that be okay? And so the question is, how much more would you want from that person a year from now than the $1,000 that you could ask them for right now, maybe knowing that it would cause them some hardship? So if you say something like, oh, I would need $1,100 a year from now, or I would need $1,500 if I'm going to take the risk of not getting paid now and getting money a year from now, I'm going to want $1,500. So what that says is that you're assigning a 50% interest rate to the risk associated with waiting the year for that money from that particular person. So that's a pretty hefty interest rate, right? You think about, you can borrow money from a bank right now for 8%. And you're saying, ooh, if I have to wait a year for this, I think I want $1,500. What if you had to wait 5 years for that money? How much would you want then? And it's not necessarily just 5 times 50%. You might go, I'm not going to do that. But you might go, wow, if I have to wait 5 years, I want, $10,000 5 years from now, because that's a really risky thing. The thing to know about this, it's kind of a fun thing to think about, but the thing to know about this is that when a buyer is buying your company, this is actually the thought process that is going through their head, because what they're paying you for, and we just described that in 2 charts ago, what they're actually paying you for is the future cash flow that your business is going to produce. They're going to buy your assets, but anything that they pay over and above your assets is because they think that your business is going to produce cash flow. And maybe they can see the next 3 months because, you've got an order book and they can see, oh, yeah, that'll happen again. But 3 years from now, you want to get value for the fact that you're not going to get that cash flow 3 years from now. So how do you convince a buyer that the earnings of the company 3 years from now are really solid and they're really going to happen? and they're really going to be valuable. And please don't put a 50% interest rate on that, because if you do that 3 years out, those earnings 3 years from now are not going to be worth very much. This is exactly the thought process that is going through the buyer's head when they're thinking about how much to offer you for your business.
So if I look at this slide then, Jim, I really want to know that person that wants to borrow money from me. Have they ever paid people back in the past? And how do I know that they're going to be around? And how do I know that they're going to have money and remember that they owe me money? There's a lot of factors I would look at, and different people I would say, I trust you, give me 1,000 later. I would just know that they were reliable and that they were going to be available. Whereas somebody else, it might be, yes, 10,000, because I don't believe it. You have no history with me. So that when you look at how does a buyer predict the future? Where does that really come from, I guess, is the question.
Buyers have a few tools that they will use to reduce their perceived risk in the business. One of them is they'll do what's called due diligence. So they're going to say to you, I want to talk to your top 10 customers. Now that might make you nervous, because then your customers know that you're selling yourself, right? So that's always a bit of a problem. They're going to scrub your historical financial statements. They might want to talk to your account. So there's a few things that they can do to reduce risk, but because the purchase value is a future oriented thing, what they're trying to determine is whether or not the numbers that you put in front of them, because heaven forbid you just let them put the forecast together, because you're not going to end up with a number that you're going to like. You need to be handing the buyer what you think your business is going to do, typically for at least 3 years. Often a good idea to put 5 years out there, and the buyer's got to decide how credible those projections are. And one of the tools that you can use to assure them of the value and the accuracy and how robust those projections are is if you've had an ongoing business planning process for a number of years, where you do a business plan, you hit the numbers. You do a business plan, you hit the numbers. You do a business plan, you hit the numbers. So by the time the buyer comes in and you hand them the business plan and you show them for the last 5 years, you've been doing business planning and you've hit your numbers every year, that provides them a tremendous amount of comfort that the projections that you're handing them are actually doable in your business. It's just such a good tool when you're negotiating price with a buyer.
So that kind of comes back to when you say people don't really invest in great business ideas. They really invest in great management teams. That's a strongly related concept. How do you prove that you have the management skills to do this projection?
Yeah, it's a truism. And over the last number of years in my startups, I've raised about $100 million in the capital markets, and a lot of it has been from venture capitalists. And frankly, they bet on the management team, because stuff goes wrong in a business, and it's management's ability to deal with challenges, which is evidenced by how did you do relative to your business plan, that really provides a level of comfort for anybody who's going to put capital into your business. We'll talk about a couple of different ways that happens later. Whether they buy your business or whether they're investing in your business, this holds true.
So I imagine even being able to share that things have gone wrong, but showing the resilience of the company and responding is actually a better story than just kind of fluffing across the top.
It's so much better than who knows.
Mm-hmm.
So, when you have a plan, you can take corrective action, and you can show that you took corrective action. Some things are not within your control. That certainly happens in business, but you can often do things to mitigate the unfortunate stuff and to really accelerate the positive stuff that might happen relative to the plan you've written down.
All right. We're going to go deeper on this as well. So the next slide, I think, is more of a little bit of a chunk up, a little bit of let's make it simpler.
Yes, and one of our guests tonight does this professionally for a living. So I'm a very I'm a very junior person in this world. Those calculations of what a business is worth, there are lots and lots and lots of companies that sell in every industry every year. And there are people who make a living at compiling the details of those transactions and then summarize them in terms of sort of normal expectations based on the industry, often based on how quickly you're growing, often based on how profitable you are. So you can get these kinds of statistics drilled down umpteen different ways from many, many, many players in the market. But I thought I'd summarize a table. So you go, well, I don't know what my business is worth. In detail, nope, that takes a chartered business valuator. We're going to have one talking to you in a minute. But if you're just looking for sort of a thumb in the air to figure out, and is this a good time to sell, and what might my expectations of exit be, this is a very good example. So this looks at by industry what you can expect in terms of purchase price. So a software company with 2 to 5 employees can expect to sell for, on average, 5.9 times their earnings before interest and taxes, or 1.2 times their sales. And that ratio, the sales multiple and the EBIT multiple, actually tells you, if you do the math, what the return on sales are in that industry. So software companies make 20% return on sales when they're really small. As you can imagine, not a lot of overhead, right? They don't have a lot of Google kind of boardrooms and chairs and things. Whereas trades are down in the 14% range when they're 2 to 5 employees. The bigger you get, generally, the less profitable you are because you have more overhead. But this is a very good example of those kinds of tables that are available generally to give you a rule of thumb until you need a really accurate number. And then there are professionals who do that.
That's a good way to set this up. I'm actually going to bring Simon on the screen. I'll do a little introduction as well as I add Simon to the stage. So really pleased to have Simon Prifstis here. He is a CPA and a CBV, and a CBV is a hard thing to earn. It is an incredible designation that allows him to be the expert we wanted to bring to you. He's the founder of SP Valuations, Inc., and has been in professional practice since 2017. He is an accredited finance professional with extensive knowledge and expertise in the field of business valuation, both as a chartered business valuator and a chartered professional accountant. He specializes in working with fast-growing public and private companies across a variety of industries, and he's gained experience through senior positions at Big Four, multinational and Canadian national valuation and accountancy firms. His valuations have been relied on by clients in the context of business, asset, and securities valuations, corporate reorganizations, litigation, and transaction advisory projects, both as an independent expert and as an advocate, helping clients navigate complex valuation and transaction requirements. And he promises to make it super simple for us to understand what that means for you. Hi, Simon. So glad you could join us tonight.
Thanks, Cher. Thanks, Jim. I really appreciate the intro. I'm a chartered business valuator and a chartered accountant by trade. Started my own practice this year. I've been working in the field since 2017. I guess trying to premise what it is that I do. If you think home appraiser, but for businesses, when people are trying to buy or sell them, that's me. In terms of trying, I guess the big what it is that I try to do is help establish for potential buyers or sellers what their businesses are worth. So there's a lot of ambiguity knowing, how do you price it? How do you know what to ask for? How do you position it for sale? So having some kind of help, which I normally, depending on the transaction, help clients through, it's helpful to have the additional advice through that process. One of the big ambiguities that people typically face is what's the difference on the transaction between price and value? So what should I ask for my business versus what's it really worth, and what's it worth to whom? So what we do is we try to work in a notional context, which means in a hypothetical appraised value of a business, what would it be worth? And then see, okay, how does that relate to current market trends and where would that position you? And that might help you through the negotiation process. So there's nuances to that, such as, is the highest price that's out there always the best? So if you think of a situation where you have a family business, if you're trying to pass your shares to your children, maybe for tax purposes, the highest value is not the most ideal, depending on the tax implications. You still might be able to skirt around some kind of a value range and come up with an optimal tax structure for a sale, depending on what your company is worth versus the price you transact at. Other situations could be, if you're using non-cash consideration for a sale, if someone's supposed to pay you, like Jim was saying, in a year or in 5 years or 10 years, or based on your future earnings, is that worth as much as cash in hand today? So how do you quantify that difference? That's something I can help with. What about situations when, if your business is your pride and joy and you've been building it for 30 years and you don't want to let it go? How do you know that the price you're asking is reasonable, and who's actually going to pay that? Or are you, does it need to be a little more down to earth in terms of what other businesses or comparable companies sell for? So I can help give a point of view in that regard. On the flip side, if you're looking to buy a business, how do you know, if you're looking for a value opportunity, how do you know that you're not asking, what you're looking to pay is not too little for what it is you're getting? So typical engagements that I get involved in, I can usually be engaged either independently as an evaluation expert or as an advocate through a transaction. So independently, it's similar to a third-party appraiser. So you might have a buyer and a seller could engage me to provide a value or a range of value what a business is worth. My position there would be as a neutral third party. If it's just one side of the transaction hiring me independently, I can also give you a range of value that'll say, what's a reasonable place to start negotiating at, right? Alternatively, if I'm advocating for you, think of it as I'm on your side through the transaction. I wouldn't be independently working, but I can help you say, okay, I think your company or the one you're trying to buy is worth X. How do you navigate how much to pay or ask the sellers for? If someone is looking to acquire your business and integrate it with theirs, I can help quantify, what's the additional margin they're looking to get out of the deal, and how do you price that in? So there's a lot of different factors depending on what side of the table I'm working on. When it comes to selling a business, so one of the big challenges that entrepreneurs face is, okay, where are we now? Where have we come from? And what are our future plans? Do they, if how we've performed in the last 5 years is totally different than what we expect. COVID's a good example because everybody's results were usually less than optimal through COVID. And the next 5 years, everything might look a lot more rosy or positive. So how do you capture your future plans into your operating cash flows, and how do you price that in? And what do you do with it all? When it comes to financial evaluation modeling, so if you're planning to normalize your operations into the future, or you're planning for rapid growth, or you're on a trajectory where you're growing fast every year and everything is great, some of the modeling or getting it down onto paper and working with your assumptions and future plans, I can help with. Also, reasonability testing on those is, if a third party does their due diligence and looks at your plans, how do they know? How are you going to know if they're reasonable or not? So this is as a second set of eyes, I can help on that kind of aspect of a transaction. When it comes to pre-sale planning, certain times, a couple of years in advance, if you think, okay, I'm trying to sell my business coming up in the next couple of years, what do I do? What can I change now that'll help me in 2 years when I position the company for sale? What are comparable companies selling for, and why are they selling for that much? And what's the difference between those and mine? And how do you bridge those gaps in advance so you can plan to get the most from a transaction? Another one would be if there's somebody interested in acquiring your business, a special interest purchaser, they're called. Again, if they're looking to integrate your operations with theirs, I can help quantify what are the synergies that they're looking to capture from acquiring you, and kind of bolt in your operations with theirs? What are those additional margins or profitability, and how do you go about quantifying those? So in addition to the value of your business, how much more should you be asking for a slice of the future benefits they're going to get that they should be willing to pay for? And then on the flip side, when it comes to buying a business, I can assist with the due diligence or some of the investment risk management sides of the transaction. I guess, Jim, you touched on this one, but sometimes how do you know the assets exist, or what's the fair market values of them? I can help with that. How do you know the sales or cash flows they're presenting you with occurred? So I can help with the testing on that to get comfort over the transaction and what financials you're receiving from a vendor. What else? When it comes to valuation models, if they provide you a forecast, how do you know it's reasonable? What are the assumptions? How do you test those? So there's a lot of reasonableness that can go into that due diligence, which helps prevent you from losing money on a transaction. When it comes to negotiation, what's better? Is it better to buy the assets or buy the business? So there's planning in that regard, even from a tax perspective. What if the numbers that they're presenting you with don't materialize to what they're saying they will? What do you do? What kind of recourse can there be? Can you build that kind of recourse into your initial purchase and sale agreement? So there's situations like that I can help through as well. And then, Jim, you mentioned intangible assets and goodwill. So I guess a common situation with that would be, or more common than most people think, is if you're looking to buy a business or sell a business and you have very few assets, think of a professional practice like a doctor, or a doctor's a good example, or a physiotherapist, for example. They don't have a lot of capital assets to the business, but the entire or the majority of the business is usually derived from their customer lists or their intangible assets. Even a software as a service provider, a lot of the times they're capital light businesses, but the majority of the value in those businesses is the customer lists and the future earnings. So helping value those, so you know how much to ask for a business, it's something the CBV can help with. Other things such as, how do you value your existing workforce, which might be, or a brand. So there's all kinds of different aspects of identifiable intangibles in addition to the goodwill that we can help with valuing. In addition, when you're buying a business, for those who might be looking to list as public companies, there's a lot of reporting requirements where you have to do the purchase price allocation to identify what specific intangibles were purchased, how do you value them, and then how do you value the goodwill? And then there's aspects like impairment testing on an annual basis that need to be done for those intangible assets.
It's interesting because I think a lot of people would not think beyond their assets. So this is so much beyond what, when you look at your own business, you would see the value as being. What a complex level of variables that you can dive into to create a story that you then can back up. And it sounds like there's cash flow, there's goodwill built into there, there's some of the know-how, there's such a diverse range of things that you could emphasize as you're pulling out that valuation. I wish we could actually keep you on longer to play around with some of that and get some stories, but we're trying to keep moving forward and get through all this content, which is probably like 6 days of content, but we're going to keep it to our time. Thanks for sharing that complexity and the fact that there are tools to actually dive in and uncover those pieces of valuation for any business. They don't have to figure this out themselves.
Yeah, thank you very much, Cher. Thanks, Jim.
You're welcome, Simon. It's a remarkably valuable expertise that most people don't know exists. So it's a pleasure to have you on today. And I know we're doing work with some of our clients with you, so it's pretty exciting.
Thank you very much.
All right, thank you. I'm going to pop you off the screen. I'm going to go through a couple more slides, and then I want to bring our next guest on to dive into one of the pieces. So we've talked a lot about cash flow and the crystal ball of predicting what that cash flow is around revenue and growth opportunities and margins. And then there's also the know-how piece, that you have valuable know-how. You do something different. That means you need a highly tuned business model that emphasizes that know-how, which again makes you powerfully positioned in the market currently for bringing in clients. understanding the market opportunity now and in the future, having processes that keep you predictable, duplicatable, so that you are, again, the business is separate from you, but it's also consistent, and you can allocate your resources appropriately, and you know what that means for your business. And having that proof of the wise management team that is able to move that business forward, that know-how also very soft, but it brings that second pillar of that three-legged stool to life, so that people can stand out from, why wouldn't you buy somebody else's business? Why this business? And so when we look at your business model, it is, where do you play and how do you win? That's really in a concise, single page, single diagram. If you can't fit it into a diagram, you're probably doing too much. You haven't really considered, what is the value you bring to the marketplace? Where do you fit in the value chain of delivering the overall transformation to a client, and how do you make profit from it? It really is bringing it down to a very logical place, even though there is an art and a bit of a science to building out your business model, being able to declare it in a solid fashion so that others can understand it, so it focuses your excellence, and so that you're delivering it in a fashion that is predictable. That's the ability to create those financial projections and with certainty meet them, comes from tightening up, cleaning up your business model in the first place. The next piece, though, is making sure that you've actually dumped the things you shouldn't be doing from your business model. So we apply some levers to your business model when you evolve it to that scale of a profitable unit one. And I'll just get Jim, if you can touch on some of the levers that we do look at when a business is looking to tighten up their business model.
Yeah, and I'll go through these fairly quickly. That business model is actually the heart of the process that we walk businesses through to help them become more profitable, which therefore makes them more valuable. And the 5 levers are decision-making surety. You have to have good information landing on your desk in order to make decisions. Pricing, number 2, the first pricing move. Are you priced to market? You'd be absolutely amazed how many small businesses are priced under market to their competitors. The third thing is, we recommend that people turn their services into SKUs, into stock units. Why? Because then you have to describe it explicitly, and therefore you don't have scope creep. Therefore, you can deliver your services efficiently and replicatable. I'll take one year-end financial statement, please, would be an accountant example of that. The second pricing was the previous part of the business model said, define the arena that you play in. Once you've defined the services that you provide, you know how you can differentiate against your competitors and you can command a premium price. When you've done all that, go out and find the perfect customer for your service, because they will value you and they will pay you for the work that you do.
Yeah, as your business grows, your model must change. This is where what got you here won't get you there. This is where it comes to life. As you look at the excellence that you've built and look at the success you've created, zeroing in on those things that do differentiate you are where that scaling of profit is going to come from. And then after that, then you've scaled your profit. You then have the processes that you need to capture so that you can scale your business. After doing the 80-20 rule to your client list, to your solutions, after fixing your SKUs, building the value up intentionally so that you differentiate and so that you are able to attract that avatar, capture and document your best person's processes so that you have an operations manual that makes you predictable and consistent. And this is a segue into data. This is just one piece, but a key one in capturing your IP and building the data that builds value today and in the future. And I'm going to actually pull Oren and Jake up to the stage and stop the sharing here. If I can make my software do what I want it to do. We'll remove that. We'll add Oren and we will add Jake to the stage. We'll also do a quick intro. I know there's a slide in here that will introduce you, but I really like to introduce people because we really value you coming here. And it's important for people to be situated into the context of who you are and the wisdom from which you speak. So Oren Horvitz is the managing director at Firepower in their value maximization division, which is a super sexy concept, I think. Value maximization must be a fun place to spend time, especially if you're a data geek. Most recently, Oren was a senior leader in PwC's value creation group, where he helped investment firms and large corporations such as Walmart, Brookfield, Rourke and Omers and their portfolio companies increase enterprise value, which you may have heard of some of those names, using advanced analytical techniques. Prior to that, he headed the investment analytics group at MRI Software, focusing on long-term forecasting and benchmarking for large real estate portfolios. He graduated from one of the top business schools in Israel, Coleman, where he became fascinated with how data analytics can completely reshape business. If you're intimidated by data, Oren is the person to jump in and show you that it is your best friend, and create the results and interpretations so that you know how they change your business. Jake Anderson also is here with us from Firepower. He's the Associate Manager, Data Science and Artificial Intelligence. He's been a leader on the VMX team for 2+ years. Prior to joining Firepower, Jake performed industry research at a manufacturing nonprofit and worked in data analytics at a technology startup. He has an MSc in Business Analytics from Ivy Business School and an undergrad degree in economics from Western University. So we are so pleased to have the two of you here. I'm going to bring your PowerPoint to the stage. Welcome to the team.
Thank you, Cher and Jim, and thanks for inviting us to Build to Sell. Thank you, Simon, as well. That was very insightful topics we were discussing. We've learned quite a few things here. And hello, everyone, and welcome to a quick intro to our data team. As Cher mentioned, I'm Oren Horvitz, and I'm joined by my colleague, Jake. We represent Firepower Capital, a mid-market M&A advisory. Firepower has grown to be an umbrella of services over and above M&A. About 7 years ago, we launched our private capital team that lends to and invests in mid-market companies. And 4 years ago, we formed our data and AI consulting division, which we represent today, called Value Maximization, or VMX for short. The story goes that 4 years ago, I left PwC's deal team, where we helped the deal teams with pre and post M&A insights, and formed VMX as a way to help mid-market companies achieve the same accelerated growth and efficiencies that PwC's enterprise clients were enjoying from just leveraging data and knowing what to do with it. To be more specific, we use data and AI for 3 things: solving business problems, increasing enterprise value ahead of a sale, and get the most out of their data assets. And Jake here is our chief data scientist and heads our AI services. Here's the rest of our team. We are now active in most industries, ranging from industrial manufacturing to automotive, recycling, pharma, software services, multi-location, retail, extremely diverse. The one thing that binds all of those clients is curiosity and belief that data can make things better. We will highlight a couple of case studies as well. Just to set the stage, according to Brian Levi, who is the global deals industries leader at PwC, the M&A market is actually a lot more resilient than the news headlines would suggest, and that sellers should prepare for upcoming sales or risk losing out. There are too many examples of how companies are using data to fuel their growth and become more efficient for us to mention today. My colleague Jake will discuss some ways in which data is important ahead of a sale and for running a more efficient business.
Great, thank you very much, Oren. So, first and foremost, as has been said many times so far, we find that being able to provide quick, granular data sets in the M&A process goes a long, long way in building up the buyer's confidence. right? Without proper data to back up your performance, there is that added layer of uncertainty that can ultimately reduce what a buyer is willing to pay. If you don't know what you're buying, or think that there's some uncertainty around some of the benefits there, you're less likely to pay top dollar. An extension of this is really getting ahead of any potential risks. So, for example, understanding client exposure, whether that's customer concentration or the quality of those customers. So to give an example, one software organization that we spoke to knew that their top line churn number, their retention rate, was worse on the surface than they would have liked. And they were ultimately worried that it would give this impression that they had this unstable customer base subscribed to their software. So they wanted to get ahead of any of these concerns by running analytics on specifically who was churning. And ultimately, they were able to make this case that those who were churning were operating the platform in languages that the business didn't fully support. And that was a conscious business decision. These were customers that they didn't actively seek out. Instead, they found their way to the platform on their own. So in reality, they were able to position this churn number for the customers that were really important to them, their target customers, to be actually quite good, quite stable. The same thing can be applied to addressing market and competitive positions. So if sales are down for the year, but not as far down as others in the market, it might be less of an issue. It was mentioned COVID in particular was a big shock. So we saw that pop up a couple of times in sort of running these market comparisons to help explain some of that performance. And in addition, having all of this open and accessible data does help make the case for some of these additional synergies and ultimate benefits to the buyer, ultimately making your business more valuable to them. So for another example, we were working with this pharmaceutical manufacturer that was interested in buying another manufacturer. And in particular, they were interested in how much production overlap they had between these two organizations. The problem is that this target manufacturer had very poor data infrastructure. And so when asked for some data to support the production planning, they gave us this 1,000-page PDF document product listing with no standard SKU naming conventions. And so, without having people on the team like us or others who could properly process, clean, and standardize and handle this data, it would have been really tough to gauge whether joining up those two production lines really made sense. And then one further benefit to mention here is that having this good data flow into timely interactive reports makes it a lot easier for any new buyers to hit the ground running and cut that learning curve if they do take over operations, especially if that sale means that the owner-operator moves on from the business and brings a lot of that experience and human capital with them. Now, of course, beyond being useful specifically in that M&A cycle, there are a lot of follow-on benefits to your business in general in building up your data capabilities. So, first of all, for any decision that you make, the speed and quality of the insights that underpin it can make a big difference. And if you spend less of your time manually putting data together and building these reports and cleaning and standardizing it all, if you spend less time doing that, it frees you up to take more of a strategic and analytic lens. Especially in the case where you have a lot of moving pieces, there are many different products, many different customers, it does make it easier to pick up on some of these high-level opportunities and trends. So a good example of this is a a cannabis retailer that we were working with recently. They had data all over the place and had to manually pull sales data for each SKU across multiple different point of sale platforms. So in a landscape where the product environment is shifting very quickly and there's lots of regulatory changes and customer demand is changing a lot and there's a lot of competition, being able to keep that really clear finger on the pulse on which products are moving, which ones aren't, and more in particular, why is really quite critical. On the flip side to this, there's the same rationale for flagging risks ahead of time. So whether that's declining customer segments or underperforming sales reps or changes in customer behavior. So for example, being able to keep a handle on how happy your customers are or if there are any pain points in any of your processes. So for example, if you're a software company, monitoring how specifically your customers are using your platform and understanding the value that they are getting from their platform, even if they don't use all of the features, if they use a subset of them, that's really quite important. All of this can flow into your sales strategies. So either tailoring your market fit, improving retention, or developing promotional campaigns. So to use that same cannabis retailer as an example I mentioned a few points ago, once we help them get their data into one central source of truth, we're able to add reporting modules on top of this data foundation. And one of them in particular was dedicated to evaluating the impact of past promotional campaigns and estimating the impacts of future ones so that they were more easily able to compete on price without just blindly sacrificing margin, especially given the very, very competitive landscape there. If your business is more process-driven, you might want to identify and reduce bottlenecks, keeping utilization and output high. It can also give better oversight into cost and revenue drivers. So for example, we've had plenty of engagements that do really deep dives into some of these customer retention problems and how that is a drag overall to top-line revenue growth. And then, of course, by having all of this infrastructure set up, it does mean that there are clearer thresholds and triggers for when things recur that require more immediate attention, as opposed to continuously sifting through reports on an ongoing basis, trying to find these nuggets in a sea of information. The projects I mentioned around retention, for example, we developed systems that continuously score a customer's risk of churn based on how they were using that platform. So if they stopped using an important feature, for example, that might bump their risk score up a lot and sort of trigger an outreach. So ultimately, this meant their customer success manager could focus their efforts on these clients most at risk, as opposed to going through this customer behavior for each customer every single week over and over again, trying to find the most immediate piece of attention. So, I could keep going with this, but I'm sure that you see the point. There are a lot of use cases for really making the most of your data there. One more in particular that's really interesting that we've seen, and Oren's going to speak to in a second, is using your data to develop entirely new revenue streams altogether.
Thank you, Jake. As Jake mentioned, there are ways in which data can have intrinsic value by just the sheer fact that a business collects good, valuable data. That can have its own value depending on the industry and context. And companies all around started turning it into or treating it as a revenue-generating asset and creating new revenue streams. Some ways in which companies do that is by selling insights directly to the market for a fee, and there are marketplaces that can be created to be doing that. Another one is by creating digital products out of data, such as an online analytics portal that provides up-to-date insights to certain interest groups like customers, suppliers, or the marketplace in general, or by creating a platform where participants can actually trade data, insights, and solutions with each other, which we use in order to service customers where we've helped customers sell their own insights. We use external platforms, but nothing stopping a business from becoming a platform on themselves. So these are three interesting ways of digitizing your data or making data digitized assets. So how do you ensure that you're ready ahead of time? Well, Gartner, which is a very well-known research and consulting firm, breaks analytic maturity into 4 phases, and each business fits into this curve at some place. The first bucket is the measure and identify. This is basically where companies are able to just pinpoint what happened in the past. Are we doing better or worse than last year? Which product lines are doing better or worse? Which customers are doing better or worse, etc. So, and there's levels to it, and especially in companies where there's a lot of high volume transactional transactions with lots of customers across different geographies. The level of the depth of these questions can become higher and more interesting. So the ability to answer those questions is important. Next level up is the diagnose, where we drill into root causes using an interactive dashboard or something of the like, and are able to answer questions around why things are happening a certain way. The next bucket is on the foresight front, which is predicting what will happen. So once we have a good established data set that we trust, which takes time to stand up, but is obviously very important for step 1 and 2, then we can start making predictions and say, well, based on historical movements and what happened when the weather changed and there was a Jays game, this should happen, and then basically predicting the future. And then the prescription last phase, which is our business's ability to affect what will happen, or to have systems actually tell us what is the best course of action based on prediction. So these are the 4 areas. Every business kind of fits into that. Most businesses are in the measure and identify and diagnose phases. In terms of what buyers are looking for, it's important that for a business to at least have the ability to measure what happened in the past, and they do place a premium on your ability to drill into the details in an ad hoc manner and answer questions about why things are happening. Obviously, the higher you are on this scale, the more buyers are likely to believe your story, to value your data, and can be more easily convinced of, and plan for the day after. There are actually 5 areas that are important to get right in order to maximize the value of your data assets. We'll just touch on them briefly. Those are data itself. Basically, do we actually have good, trusted data set that we can mine? I mean, I know it sounds simple, but this is actually where most companies are stuck at. That's number 1. Number 2 is technology. Do we actually have the tools to store the data, mine it, distribute insights, etc.? Third one is competencies. Do we have the skills necessary to mine the data and build models and store it and validate that it's correct and all of that? The 4th is processes and governance. So do we have the right policies and standards to ensure that on an ongoing basis, whatever data we have, whatever reporting we use, it's sustainable, and it's not one day we get a report that says this and the other day, things suddenly change on us and then we lose our trust. And the 5th, very important, is culture. Do we think that, does our management think in fact-based or believes in fact-based decision-making? All of these are important to get right. And in terms of areas where we've helped our clients, and what we actually do is we do data and dashboard development to help management see the numbers and visualize and look at trends much easier. We automate a lot of the back-end stuff. There's a lot that goes under the hood to building data systems. We use AI and pattern recognition to mine the data for us so we don't have to, and that we can flesh out insights that would have taken a human being maybe 1,000 hours in a split second. We help them manage and govern their data better. We help them build performance and track their performance. And all of this flows into business strategy and hopefully affects business strategy. Data strategy should affect business strategy. So that's what we do. So we're nearly at the end. We just wanted to kind of flesh out some common myths about data and analytics that we feel, are pretty, people ask us all the time, and we thought we're just going to discuss those and answer those in real time. The first one is we need to have good quality data available before we get started. So yes and no. Yes, you do need to have data that you trust. It should exist somewhere in an Excel spreadsheet, in emails, in PDFs, etc. If you don't have data somewhere, it doesn't have to be in perfect shape, then there's nothing to discuss. Then an implementation of an ERP system, a CRM, or just better policies and procedures is due. It's fine if the data is not organized, though. If it's all over the show, and it's different systems, spreadsheets, etc., it's extremely workable. We have not worked with one client that has had this thing kind of sort out and convenient all in one place. This is just a reality of things, and it's not a problem. Key thing to remember is that these things, standing up these capabilities, this automation, mapping out the data, does take a bit of time. So a typical project to stand up these capabilities can take anywhere between 3 to 6 months, let's say. So if you do feel like this is something that's important for you, I would advise not to wait up until the last minute to get this right. The second one is we need to know exactly where to start before engaging in a data project or with a data team. No, that is incorrect. All you need is data and a basic idea of what you're after, optimizing your operations, like benchmarking your performance, finding ways to cut costs and time, increase your productivity, or right-size your inventory, things like that. Or maybe it's a top line that you'd like to optimize, like understanding who your best customers are and how to find more of those, and how to keep the ones that are the existing ones happy, align pricing with demand and inventory with demand, find where to best expand to geographically. Or maybe you just want a dashboard to help you see what is happening clearly and allow you to drill down into root cause. So definitely do not need to know exactly where to start. This is a conversation we can have, and just by having an idea of what you'd like to optimize, that will go a long way. The third one is we need to possess data engineering or data science skills to get started. That is important if you'd like to build your own. This is something that we hardly see in the mid-market, and we are fully incented to say that because we are an advisor, but we would highly advise you use someone such as ourselves to stand up these capabilities and help you mine the data and get there faster and more efficiently. So definitely no need to stand up your own capabilities, which can take years in some cases. And the fourth one, a data analytic exercise is too expensive for us. Not necessarily. First and foremost, if done right, ROI on data projects can be higher than 10 times. And another way to think about this question is, and I hope our session made it clear, is that what is the price of not treating your data as an asset ahead of a sale, in terms of how buyers view your business, and and just a general loss of opportunities to optimize your business and increase your valuation and top line. So that's as much as it goes for common myths. And this is where our portion ends as well. Thanks again for lending us your ear, and we hope this was an informative session. Back to you guys.
Well, it certainly is fascinating to me that I don't necessarily need to know what data I need to have to be able to ask you, how do I optimize something, right? That ability to have that conversation and say, I don't know why this bottleneck exists, and to then discuss that with you so that you can say, well, let's look at these different facets. Your ability to love data and know where you should be looking, because I think as someone who is gearing up saying, if I have a business I want to sell in 5 years, how do I bring that efficiency? How do I really understand my business that much better and optimize in so many areas? That's something that you've helped people with in the past. So you are the expert on where they're going to get the biggest bang.
That's we'd like to believe so.
Having been through business sales, there's the concept of to share with our viewers here, a data room. So in a transaction, you also, I guess, guys, have the experience of knowing what exactly the buyer's going to be looking for by industry, so that you can reverse engineer the preparation so that data is already there and has a history in order as they head towards the transaction.
For sure. Yeah, that can be extremely helpful in setting the stage and helping us look at the right data ahead of time.
Excellent. Well, we'll have another conversation offline, because it just opens you up to a lot of possibility of how to build that value outside of assets. That ability to say, this is the inner workings of our business and we know it and we stay on top of it. So thanks for bringing that to us this evening. We'll pop into the nitty gritty of what it really means as you start contemplating actually selling the business. And I'm going to bring Jim in to talk a little bit about this nitty grittiness of when and how and so on. I really like sharing this roadmap, because there are different stages that we meet people on in their business growth journey. Sometimes even at the self-employed level, they're thinking, I want to sell my business, and needing to understand that you cannot sell a self-employed business unless you have a lot more going on, that you have, it's not the business itself you're selling at that point in time, it's your methodology or it's your idea that you'd be selling as opposed to the business. So as people travel this roadmap of growing from owner operator to owner manager to owner leader and then owner investor, their business is a different package along that path.
So, I got to say it, this is where the rubber hits the road. So this is our roadmap that we work with clients. Every business is on this journey. There are some specifically good times to sell a business. I think the table earlier that we looked at, multiples, says that essentially larger's better. You get higher valuations for larger companies, all else being equal. If you're a large engineering firm trying to buy up small engineering firms, there's an expense of doing the acquisition. And if the firm's too small, it just doesn't make any sense because there's a cost to doing it. You want firms of particular size. So that varies by industry. But in general, you probably don't want to sell a business, or you're probably not going to achieve the highest reasonable value for where you are unless, as you said, Cher, you're extricated from the business. And you'll see on this diagram that we've got up here, the O-O, that's actually for the first 3 phases or first 4 phases, that's owner operator. You're still the operator of the business. So you have to find a very particular buyer to want to buy a business that is dependent on you. It's not impossible, but it's likely to attract a much higher price than if you're an owner manager, which means the business runs by itself and you manage it. Or an owner leader at 0.7, where it really is operational and maybe you're truly just in the executive suite. And then an owner investor at 8 means the business runs independently and you're retired and you're collecting dividends from your company. So different valuations at different points, but the basic transaction really needs to happen after you are no longer directly part of the business, is where you're optimal. It's what you're aiming for to exit.
And so when you hit that level where you've scaled your profit and it's ready to grow, there's an opportunity to let somebody else do that work or do it yourself. And after growing, there's also an opportunity for somebody to have different benefits, integrating that into their business as well. So what's wonderful here is there are experts. It is really valuable to figure out where are you on that roadmap and when do you want to sell, and to make that decision early on so that you can be heading in that direction and knowing what team you're going to need, because there are a lot of implications that are part of the criteria of making those decisions. When we pop into the transaction itself, there is a who, what, when, how, and why, with a whole lot of options to consider. And it is as unique as you and your business, your goals for the sale of your business, and what level of participation you want to have in that business after you have sold it. And that possibility is something that you may not have even considered. So I'm going to get you to start. We'll quickly touch on each of those pieces, starting with why would you sell?
So the purpose here with this list, and they are really lists, and each one of them, would warrant a huge discussion on its own. But we want to go through them quickly to expand your idea of what might constitute selling your business, because it's not a straight out, there's a buyer, I'm going to sell my business. There are lots of different ways that can happen. So why am I selling my business? Do I need cash personally? Does my company need cash? Do I want to take risk off my plate by cashing out some or all of my very successful business that I've built? So liquidity just means I want some cash out of this thing. And there are a few different ways to do that. You could go public. You could do lots of things. I know that's not in the purview of a small company, but as you head towards, as you build your success, it wouldn't be unusual for somebody who's still officially a small business with less than 100 employees to maybe be thinking about heading in that direction. Do you need expertise in your business? Are you just not big enough and you need to partner with somebody who's bigger to have critical mass to go after a market opportunity that you can see that maybe you have a unique way of serving? Do you need connections from venture capitalists who could integrate you with other people in your value chain or your supply chain? So maybe you want to sell part of your business. So why you want to do this is really central to making decisions about a lot of other things in the business, in the transaction.
And sounding like a lot of options. And how much are you selling as well as you answer that question?
And Simon spoke about this a little bit. So who is the right buyer? Is it a third party? Is it family? Is it maybe you want to sell to an employee group? I think that's quite typical, and there are some tax advantages to doing that. Do you want to actually merge with a company that's in your industry or an adjacent industry or somebody higher or lower than you in the value chain, because that way you grab a more important part of the value chain, makes you both more valuable. So thinking about who the right buyer is as intentional a decision as deciding who your customer should be. So you should have an idea of who you think will want to buy your company for the most significant value. And you want to guide, as you're thinking about exit, you want to guide your business towards that opportunity.
If I can just mention too, that you've said buyer on all of these potential buyers, as opposed to letting them take over, gifting them the company. If your business is attractive to sell, it's because it's going to generate future cash flow, profit, and wealth for that new buyer, including whether it's a family member or an employee. And there are multiple ways to manage things differently, depending on who the buyer is, but they're still a buyer. And I think that's important to point out.
Yeah, this is of course, if you're gifting it to somebody, although it's often the case when we start talking to clients who are really subsumed by their business or really being consumed by their business. And one of the comments that comes up sometimes is, I just want to sell my business. And, a reasonable observation says, if it's killing you, why would somebody want to buy it? Because it's going to kill them. So Obviously, you can't sell the business that's killing you. You can't even give it away sometimes. So yes, there is a buyer, not in the sense of, it doesn't have to be in the sense of financial value, but there's clearly a transaction that's going to happen between you and somebody else. How will I sell? Simon talked extensively about this. What does that transaction look like? Are they going to pay me all cash up front? Are they going to pay me some cash and make me hang around to help them run the business, and then tie some of the sale price to how well the business does? If you have a business plan, maybe they tie the purchase price in the future to achieving your business plan. That is a thing that happens with some regularity. Maybe they're a larger company and they'll buy your shares and they're going to give you shares of their company. And maybe for you, that is just a tremendously effective thing to do, whether it's from a tax perspective or from a belief in the growth of their company, especially after they, acquire yours and integrate it. Going to spend a couple of minutes on this because we talk to clients a lot about tax efficiency. Selling a business triggers tax almost always. And so being organized in the right way at the right time prior to executing your transaction can make the difference in, depending on what your business is worth, hundreds of thousands, typically millions of dollars sometimes, in absolutely straight up, you just don't have to pay those taxes as long as you're properly organized and the transaction happens in a particular rule. And while I'm not going to go into the detail, what you probably look like now is the picture on the left, which is you have an operating company. We call those opcos just to make it short because we don't know the name of your company yet. And you own it directly and you pay yourself salary and dividends. Where you're probably going to end up as a small business in order to minimize your taxes is something like the picture on the right. And there are tax experts to help do that. So we work with those folks to get you set up to really make the future transaction tax efficient for you. And then what are you selling? Are you selling a turnkey thing? Does your company have a particular strategic value to an acquirer that makes it worth more than the future cash flow of your own business? Simon talked about that. It's important to understand how the buyer is thinking about your business, not just looking at what you do to earn money, because it's possible that you are a key piece of a strategy that they need in order to execute, and maybe you're a key unique piece of that strategy. And if you know that in the negotiations, you can often negotiate a very handsome premium to what otherwise would be the normal, hey, my cash flow is this and I'm going to get paid for that. It's really important to understand the buyer's motivations and how your business fits into the buyer's strategy.
I think that you can see a lot of interplay in all of those, right? Who you're going to sell to can even change what you're selling in that case, because if it becomes an additional piece that they can bolt on and capitalize on because of the business they already have, it really changes what you're selling.
It can also impact your structure. And just a little bit of story from my background. One of our genetic testing companies, we had a number of tests, and one of the tests that we put out into the marketplace displaced some very large players out of their market share. So those players wanted to buy that specific asset. They didn't want our technology and they didn't want the tests that weren't competitive with them. They basically wanted to take us out of the market. So that was worth more to them because of their losses that they were incurring than the value of the asset that we were selling. So it's important to understand how you fit into into your buyer strategy.
I would think this would make you think about your competition in a whole different way if you have an exit plan of selling in mind, that your competition then may be your purchaser in the future.
Absolutely. And I know, I mean, we've structured this. We've structured this session tonight and tomorrow live in person to be positioning you as a seller. But really, everything that we're talking about could also position you as a buyer. So when you're thinking about, because it's just the other side of the transaction, all this stuff is true on the buyer side as well. So yes, you can be thinking of your competitors as potential acquirers of you, but you can also be thinking of you being an acquirer of them. And that really doesn't occur to a lot of small business owners. It is a way to grow your company. And as long as there's financing available, or the seller is willing to do a vendor take back because they believe that maybe you have some abilities that they don't have, there's a lot of opportunity in the market for co-opetition or mergers of companies in the same industry.
Yeah, I think it's very important that if you begin with the end in mind, if you have that exit plan in mind and what you want to build between now and then, right? What will I be selling? What will I be passing down? What is the legacy I'm wanting to create? Having that 5-year plan, 10-year vision, 100-year vision of what your business could be when you are done with it is going to give you that ability to then say, how will I get there? So if it is about acquiring 1 or 2 or 3 small firms so that you reach that critical mass that you do need, your vision of success is what informs the questions you're going to ask about your company. If you're sitting in today's opportunity instead of looking at the long term, it really puts blinders on you to what is available out there. So it keeps tying back to the business model and what is winning going to look like for you. And it generally means you're thinking much longer term so that you can steer in the direction that you reach the results, both in the game of business, which is so fun, but also the impact it's going to have on your lifestyle, your family, and having a balance to that. Because most people who are building a business of this size, when they're not under incredible stress and anxiety, love building businesses. They enjoy the challenge. They enjoy the ability to create something from nothing. And balancing that with a specific vision of how long do I want to be part of this success? When will I be bored? Because you want to sell before you're bored as well. We've seen a couple of businesses we've met who the pandemic just exhausted them. And as they're bringing back the business, they're finding it isn't as passionate as it used to be. So refining your business model, making sure it's inspiring to you, and knowing when it's going to stop being inspiring, may be one of the points on that path of business that turns you into that serial business owner as well. How do you figure that out? It really does start with a sounding board session with myself and with Jim so that we can identify what that vision is, where on the roadmap you are, where you want to drive your business success to, and then tap you into the experts that are part of our network to start diving deeper. And that is the content at such a lovely high level to get you a feeling for what does it really mean to build a business built to sell. I'm going to see, we still have Oren and Jake and Simon in the waiting area. We'll bring you back to the stage just to say thank you, and any last questions or ideas that we would want to address from the group point of view, because you can hear that we've got a lot of different experience in the room. And we're all back. Thank you all for being here. Boy, we could take a week and expose people to the knowledge as it pertains to their business, as opposed to 2 hours of of sharing. Any last comments or ideas, Jim, that you would like to share?
That whole built to sell. Really, if you build a company that somebody would buy, you're probably going to love running it. So building something to sell doesn't mean that you're going to exit. It means that you'll have built something that operates smoothly, that has a lot of valuable, that is independent from you. And those are all incredible attributes to enjoy being the business person that you certainly have the opportunity to be.
Is that something, Oren and Jake, that you experience, that as you get people ready and you're helping them really be on top of their business and feel like they're wiser, stronger business people, is that an interesting shift you get to witness?
I'm not sure I understand. Can you please repeat that?
So as people are considering getting their business ready to sell, and you're helping them with their data warehouse, and you're helping them understand their business and clean it up and optimize it, do some of them say, maybe I don't want to sell this house I just redecorated?
I mean, that for sure happens with some of our M&A mandates at Firepower as a whole. We have been fortunate enough to get involved in situations where, we've done enough good work that, those businesses were sold. So I can't really comment on that too much.
Having said that, though, leading up to that, we certainly do see a shift in sort of how proactive, how interested, how engaged a lot of the senior leadership is, especially when they reach a point where they're going from trying to understand their data as a giant spreadsheet with a billion different numbers that they have to look at every day, to something that's very clear and concise and takes them 2 clicks to check each day. The amount of time that they spend thinking about their data and asking questions and coming back really excited with, oh, we were looking into this, now we've got questions about this, let's start digging a little bit more. That's a really neat thing to see as well.
Well, when you describe the idea of being able to look in a business intelligence dashboard and something that would take 1,000 hours of digging and pulling together, that you just at a click of the button in a couple of seconds, you have the answer that you actually wanted in front of you because it's a custom designed query.
Absolutely. And to add to that, some of our mandates are all about automating some of these interactions, some of these processes where data gets housed and calculated. And in some cases, just by the sheer of automating it, dashboard excluded in this, let's say in this case, in some cases there are in the thousands of hours of man hours that were saved just by the sheer of doing that. And this is something that's also ongoing. So every year we get to benefit from this kind of one mandate that improved our data operations to the point where we don't have to enter things into spreadsheets and pull and copy and paste and pivot and all that stuff, as well as the benefits of having a dashboard that can drill through to root cause and answer some of our questions. So we get benefits on both of those areas.
Nice. Even hands up. Don't even have to click and look. It's already happening in the background.
That's it.
And Simon, as we were sitting here, ideas that have cropped up about some of the things that business owners really need to understand?
I think it's always reactive to seek out, on a business sale. The majority of situations, it tends to be reactive. When it's more proactive, I see that happening more with the tax planning, structuring, and stuff. Pre-transaction, there's a lot more thought that goes into it, and people realize, wow, there's so much opportunity, even on the tax planning front. But it's absolutely fascinating if people actually step back and say, hey, maybe, see what resources are out there to say what could happen on a sale before you're actually in the middle of it, and planning wise, because there's a lot more, if you could change your revenue model just to be some kind of contractual or recurring as opposed to one-offs, that might double your multiple. There's so many factors that could change proactively that if you have the data established to support that, okay, the change has been made, that's worth a lot more to somebody if you have that clarity. So it's absolutely fascinating what opportunities there are there, even on a data front. to do that, especially, in the advent of ERP and dashboarding tools that are out there. There's a lot more clarity a business operator can get on those perspectives. And then it helps in the sale transaction too.
Such a huge point, being proactive and looking into the future instead of waiting till you're kind of forced to, as you say, reactive. You have so many fewer choices when you're in a reactive situation than stepping back and going, why don't I just explore this?
Yeah, I've had, clients where they say, oh, someone wants to buy our company right now. I need a valuation in 2 weeks. I don't even have time to get you what you need to do it, but I need it. So I know what I'm worth so that I can, enter negotiations that they're not ready for. So it's a lot of the times the buyers will put pressure on a vendor in advance to say, look, our due diligence is done. This is our offer. You've got a couple weeks to reply, or a week, and they'll put time pressure on, and that's not a good spot to be in.
All right. Well, thank you for all that you brought to the table this evening. This has been absolutely fascinating. I have a bunch more questions, and I'm not going to go there, but you've opened me up to thinking about some very different ways that businesses can think about their own business, right? If you've built a business that is already bigger than you can tell because it's keeping you up nights and you're working way too hard in it. There is the opportunity to go backwards, but the opportunity to go forwards with the experts to help you getting past that hurdle. If you're going forward, having an exit plan in mind and having a team to help you make those improvements and position yourself proactively in a place of decision making is absolutely essential for you to reduce your stress, have some peace of mind, and know you have a team to support you in whatever direction you do decide to go, right? It's not an all or nothing proposition. There's so much fine granularity to this that you can tap into. So thank you all. I hope that our viewers enjoyed this and can bring some questions after the fact. We look forward to speaking with you more about how do you begin with the end in mind from the place that you're at today. So thank you all for joining us.
Thanks, everyone.
Have a good night.
Thank you.